The new Fed chair just made a move that could matter more for mortgage rates than even a rate cut. Kevin Warsh held his first meeting as Federal Reserve Chair, and while rates stayed the same, he made one significant change. The Fed removed its forward guidance. That's the practice of telling markets where it thinks rates are headed. Warsh's argument? Well, the Fed has spent too much time telling markets what to think and not enough time listening to what the market is actually saying. So what does that mean for mortgage rates? Well, maybe not much today, but potentially a lot over the next year. And here's why. Mortgage rates don't directly follow the Fed. They're driven more by inflation expectations and the 10-year Treasury. That's why mortgage rates can fall even when the Fed doesn't cut rates. Warsh also launched 5 task forces to rethink how the Fed measures inflation, tracks jobs, gathers economic data, and communicates policy. In other words, this isn't a minor adjustment. It's a top to bottom review of how the Fed operates. And here's where it gets interesting for home buyers. Oil prices have been easing, shipping concerns are improving, and gas prices have started moving lower. And historically, lower energy costs help reduce inflation because they affect nearly everything we buy and transport. And if inflation continues cooling, mortgage rates could move lower before the Feds ever cut rates. That's why this story matters. The housing market doesn't need a Fed rate cut to get relief. It needs inflation to keep moving in the right direction. And that's exactly what investors will be watching.